Dr. Craig Everett, how are we? And I said doctor because even though you said you don't have to, I wanted to at least introduce you with the credentials you have. How are we today?
Doing great. Thanks for having me, Ryan.
I am super excited. I was just telling you before we hit record that I've been following your study and I've been referencing it to people in the presentations that I give just because I think the last report when I printed it off, it was like 150 pages or whatever. I don't even know if I double-sided it, but so much valuable information in it. And you guys are just about ready to launch the most updated survey. And a lot has happened since the last one that you guys had published. And a lot of the markets have changed. But why don't you give everybody just kind of a flyby of your bio, like what's your background and what's the study, and then we'll go back and we'll unpack a bunch of it.
Okay, well, my day job is I'm a finance professor at Pepperdine. Came into academia a little bit late in life, so I have actually a lot of real life experience, both in consulting. I was at Northrop Grumman for many years and at a couple of startups. Then went back and got my PhD. Actually, a little bit late in life. I was 40 when I started my PhD, and that's that's a little bit interesting because everybody else is in their mid 20s, and I'm sitting there at 40, and so it was quite the experience. I had it was all of my advanced math was on my transcript from my undergrad days, but it had been 20
rusty.
years. Yeah. And not just rusty. See, I thought it was going to be rusty. And I thought it was like, oh, this will all come back and I'll just I'll remember it, just have to brush up a little bit. But it didn't. I had to relearn it from scratch. All the kind of the advanced calculus and beyond that, the linear algebra, differential equations, it was completely gone because I hadn't used them in my career. So I actually had to relearn those to be able to compete against these students. Especially ones from like Russia and China that already had PhDs and were doing a second PhD.
Oh my goodness!
And so it's like it was a really stressful 4 years. That was at Purdue.
Why did you go back, Craig?
Interesting story. So my original plan when I graduated from college was I wanted to be a professor, but then I kind of got sidetracked. I got into consulting. That was interesting. Then I got married, and I didn't want to be poor and go back to school again.
That's a solid sales pitch, right? Like, I'm just going to sit here, not earn any income, and just become smarter while you're taking care of everything.
Exactly. And so it was when Northrop actually sent me back for an MBA, and I was in management and such, and so I was sitting in class and looking at these professors up talking to us at the front of the class, and remembered it's like, hey, that's what I wanted to do. So basically, that reignited that desire in me to be a professor. And so once after my MBA and when I fulfilled my 2-year obligation to the company after I finished, I went back and got a PhD. I was even though I was very qualified on paper, I was kind of too old for a PhD, and so a lot of the programs that I would have qualified for earlier in my life, I didn't qualify anymore because of my age. And
really? I did not know that. I did not know PhDs were age related.
Well, I mean, they're not technically, but look at it this way: it's a fair criticism. Essentially, PhDs for the most part are free. If you're in a full-time PhD program, they give you a stipend and no tuition. That's the typical doctoral program, particularly a PhD program. Now, DBA, that's different. That you pay for. But PhDs, it's a research degree, and so the university is actually investing in you, and they want to invest in people that have a full career instead of half a career ahead of them. So it's just kind of a efficiency thing.
A half a career. I know. I can tell you what my partners wouldn't consider themselves halfway into a career, but yes, super fascinating.
So that's the idea. So I mean, I was fortunate to get into the program that I got into. It was a very good program, and so that was my journey back into academia, and I really like it. I mean, I liked Northrop a lot, but I noticed my kids were fairly young at the time, and it seemed like as time went by, and I went higher and higher in the company. I was seeing my kids less and less. And so being a professor kind of gives me the flexibility to spend time with my family and organize my time the way I want to, rather than the way somebody else wants to.
That's awesome. So did you jump right into teaching right after you got your PhD then?
Yes.
So I would love to, and I don't know in the timeline where this study came from, but I'm kind of curious on like, and for the audience, what are the topics that you teach? Why did you pick those? And then how did that transpire into what is now the Pepperdine study?
So both my research and teaching interests are entrepreneurial finance, private capital markets. I also teach entertainment finance at Pepperdine for the people who are doing an entertainment concentration. Yeah, entertainment finance is fascinating, actually, because they use a lot of the same words that normal finance is doing, but they mean them completely differently.
Oh, super fast. Well, and I noticed that because I don't know where in your time, if I'm stealing part of your thunder from the future, but you've written children's books, which I thought were so fascinating. And I was like, because I just think about me trying to teach my kids like what we're talking about. Like, I don't even know where you'd start. And you've got, I think one of them is about entertainment financing, and it's a book, or it's an encyclopedia about jargon in the industry. I don't know if that's a children's book.
That's the thing. So when I teach my entertainment finance class, my main goal is for students that are interested in the film and television industries in particular, that I want them to be able to sit in a meeting discussing finance and be able to understand what the heck is being talked about. And you can't just look stuff up and Google it and during a meeting, because that makes you look like an idiot. So you have to have some vocabulary. Just one example. Something that's different from entertainment finance and regular finance. Term sheet. So. So, most of us think of a term sheet in a particular way. It lays out, it's supposed to be in basic English, the terms of the deal, like a
supposed to be, but until the attorneys get in touch with it.
So, and then, so both parties, sign the term sheet, but it's not legally binding in normal finance. That just demonstrates the understanding of both parties. Then it goes to the lawyers to write the actual investment contract. And so, in entertainment, the term sheet is legally binding, because that's usually as far as it goes. Hollywood's kind of loosey goosey, and so so the term sheet is very different between the two. You'd think it'd be the same thing, same term, but it's not. It's actually the final agreement in a lot of cases, particularly
very
in
different use
films.
case.
Yeah.
So what was your passion, Craig, in finance and business finance, and specifically like the private markets? Like, I mean, all the different places you could go focus. I mean, especially with, I can only imagine when the timelines that you're getting this. I mean, the amount of attraction towards Wall Street and private equity and all the big markets. It's easy to make more money, easy to find a niche and provide value that direction. What was your interest in this particular marketplace?
Well, I think it's because historically my family has been entrepreneurs and like small business people and such, and starting with my grandfather, who had the Everett saw company, and he made they made buck saws, and so we all know what happened there is the chainsaw kind of replaced the buck saw, and a
little bit more effective.
So basically that buck saws became obsolete, but for a while for a long time his family survived on his saw company, and my dad, my sister, and myself. It's like everybody's kind of been involved in the entrepreneurial space, not necessarily like the tech space, but just regular small businesses, restaurants and gas stations and car washes and real estate and that sort of thing. And so it's kind of in my blood. My father is deceased, but he would be very disappointed in me that I'm a professor and not doing real work.
Oh, come on. Well, I'll tell you what, and this is where, like, before you and I hit record, like, my passion for finance, Craig, is like it's such a backwards way that I got into it, because like I was telling you a little bit of our background story, and like most of the challenges that we dealt with in the business we were wrong or incorrectly financed, and like the access to the right kind of finance and the right kind of funds to support the growth and to understand what the hell we were doing besides just trying to sell more stuff. And we just never got the translation into the stuff, into the language and the useful information that you provide now. So like mine was out of pure like almost a complete frustration. And so like when you thought about jumping into finance and specifically business finance, what was your intent with going into it? Like what was the impact that you wanted to make?
Well, I think the impact that I wanted to make is I wanted to help particularly entrepreneurs understand finance, understand how it impacts them, understand the sources of finance. And, if there are always other avenues to go, if you don't qualify or don't get investment from one source of financing, there will be ones that you do qualify for. Now, as you go along that continuum, the deal terms won't be as good and such. But there's pretty much always money out there, and it just kind of depends on what the terms are.
What is your experience with entrepreneurs knowing that?
Usually entrepreneurs don't know much about it. In fact, that's a question that we ask in our survey, and generally the entrepreneurs don't know generally a lot about business. They have an idea, they have technical knowledge, but if they're a first-time startup, they usually don't know the business side very well, and they don't know how to qualify for capital. They don't know what investors are looking for. Now, we were talking about the private capital markets project. I also involved in I'm the director of the Most Fundable Companies competition at Pepperdine. And that's a specific goal of that program, is to help educate entrepreneurs on what investors are looking for, because usually they have no idea, and they go through our process, which is pretty rigorous. And the biggest takeaway, even if they don't make our winners list, is they learn what investors are looking for and what T's they have to cross and what I's they have to dot before investors will consider making an investment in them.
Well, in that topic right there that you just brought up, I think is going to be able to be a great place to continue to launch this conversation, because before we hit record, we were talking about, people understanding valuations, and then like what actually creates more value, and essentially thinking about it from an investor perspective. And what I have found over and over again, Craig, is that on the podcast, when I've interviewed people, they learn what creates value after their biggest deal or their only deal is done. And so it's like this, oh, wouldn't that have been nice to been able to look at my business as an asset the whole time, and then all the time and money I'm putting into this, if it's actually growing it in value or not, and like how the most effective way to grow it is. And they just don't necessarily look at it from that lens. So why did you talk about like capital, and maybe we just take that topic we were talking about of cost of capital, and like, I don't know how to re-engineer what you said, but like, you want to take that and then just kind of complete what I was talking, what you were saying about the cost of capital and how people view value?
Sure. So now with the big public companies, it's really easy to know the value, the market value of the company. You just take the stock price and multiply it by the number of shares outstanding and add in your long-term debt, and pretty much there you've got the value of the company. And you can know that value at any moment in time. Mm-hmm. So with private businesses, it's not that easy. The only time you really know for sure the value of the company is at the time of a transaction, like an equity transaction. So at that point in time, you know exactly what the stock price is because somebody bought the stock at that price. But other times, most business owners have no idea what the value of their company is and whether that value is growing or shrinking. Mm-hmm. And so that's one of the things that we're trying to get at with the private capital markets report and project, is that cost of capital, and be able to use that for valuation. Because so this is the deal. So if your company, and this is kind of a very in a nutshell explanation, If your company, its ROI, return on investment, is greater than your cost of capital, you're growing your company. The valuation is becoming larger. If your ROI is less than your cost of capital, then you're bleeding value. The value of your company is shrinking. And so that's why it's really important to understand both what your cost of capital is and what your returning is, because then you know, am I doing a good job? Am I growing my company, or am I shrinking my company?
That's so beautiful, Craig. I mean, honestly, like what you said in a nutshell, like that. And we're going to talk about how to figure that out and what that means. But like the amount of people that don't know that is so staggering. We never did. I mean, like, and to understand that in that simple terms of if we are exceeding the cost of capital, then we're actually making progress. Because I think as so many people, Craig, like the pure frustration comes from, am I on track or not, Craig? And if I can't tell you that, I'm constantly living in limbo land or the gut feel. And it's like this decision that it's I think that's where a lot of the flashy object syndrome comes from, is just not knowing and not having a guiding North Star. And so for the listeners, if you could do me a favor and let's kind of break down, like, what do you even mean by cost of capital? So like, yeah, they're just taking run with it.
Okay, so I mean, cost of capital, generally what we're talking about is a weighted average cost of capital, where if you have bank loans, your cost of capital for those loans is the interest rate. If it's an equity investor, your cost of capital there is going to be the expected returns of the investor. So the problem a lot of business owners, and we ask this question, and we ask private business owners just generally in our surveys, okay, what's your cost of capital? And it's amazing how many people will say zero. They say, okay, we don't have any loans, I don't have any outside investors, therefore my cost of capital is zero. That's not actually the case, because you have your capital invested in there and you have opportunity cost. You could have just take that money and invested in the S&P 500 and get, an average of 10% return plus or minus, over time. So your cost of capital has to be at least 10%, because you could have invested your own money elsewhere. Mm-hmm. But of course, your risk profile for your business is much higher risk than a fully diversified S&P 500 portfolio. So you got to think, okay, my cost of capital must actually be higher than that 10% mm-hmm. S&P 500, because if I were to get outside investors, they would have to be compensated for the extra risk. So they'd have to be getting that 10% S&P 500 return plus a lot more to compensate for the risk of investing in a private business, an individual business.
Illiquid small private business.
A liquid small private business with huge idiosyncratic risk. It's like, so most equity cost of capital estimates generally are kind of in the 25% or so. That's from private equity. Now venture capital tends to be a little bit higher, where their expected returns are more like 35%, mm-hmm. 35%. But most business owners have no clue about this, and they don't realize that opportunity cost piece of it, where mm-hmm. even they themselves could invest in something else if they wanted to instead of their own business. So regardless of whether you have outside investors or loans, you do have a cost of capital.
Well, and what I think is one of the big key components here, Craig, that I see as an issue of why this is the case is that what one thing that I've gathered over the years is that a lot of entrepreneurs that are founders, when I think about a lifestyle business, they, like my dad and I, running a lifestyle business where you're solving for annual income. How much cash can I pull out of this company from perks, distributions, etc.? And it's a very expensive, very stressful job. And they don't view this thing called the asset, which has equity. And so they kind of going back to what you were saying is someone can say it's zero because they don't see their company as an actual asset. So they don't see the opportunity cost of, even it might be worth $500,000, you could still put it in the S&P 500 if it's only $500,000. So they don't even have that kind of clarity to even say, what are my opportunity costs? Because they don't view it that way. And so I don't know if that's something that you've kind of gathered throughout the study, or if you guys peel that back.
Well, yes. I mean, and also from my family history, I know my dad, his goal with his business wasn't necessarily the value of the company. It was maximizing his own personal wealth. And so but will yield a very different strategy than if you're actually trying to sell your business, because most valuations of going concern businesses, profitable businesses, they're going by some EBITDA multiple, EBITDA, earnings before interest, taxes, depreciation, amortization, fancy way of saying profit. So it's some multiple of the profit is what their company will be valued at. Well, my dad was not trying to maximize profit because that would have maximized his taxes. And so
the truth.
So he's trying to minimize taxes. So he's trying to make sure the company has as little profit as possible, and he's kind of like, sucking the business dry, for certain, trying to still stay in business, but trying to take out as much as he can. And so, and a lot of business owners are like that. They're not necessarily trying to maximize profit because, they're trying to maximize their lifestyle and minimize their taxes. But if you're trying to sell your business, you have to kind of reverse that and start trying to maximize profit, because that's what other people will look at when they're buying the business.
Yep. Well, and I think that lens, Craig, is so helpful, where you're looking at the business from the back end of as an investor's mindset, which is, what should the return of this thing be that we're creating wealth with? And unless you somehow have shifted your mindset, been through transaction, or like have, gone through your courses and in education, is like, how else do you understand that this thing is an asset and what those trade-offs are? Because I don't think, using our word intentional, I don't think very few people I know have intentionally decided, I'm either going to maximize personal wealth, lifestyle, business, that's fine, and my expectations are such, versus I'm going to maximize the value of this company by funding it the right way to get the value that I want. And it's an intentional choice. It's usually, I want to maximize my personal wealth and I want to have the highest valuation possible when I eventually go to sell it. I don't know if you've got similar experiences.
Yeah, those are mutually exclusive. And that's one thing that VCs, when they're looking at potential investments, they look at the founder and, they have to make a determination. Is this guy trying to maximize his lifestyle? And, and if so, that sends up red flags. Okay, this could turn into a lifestyle business, in which case the VCs will be screwed. And so, they're trying to make that determination. Is this person trying to grow the business as fast as they can for the next 5 years and then get out? Or do they want to be king and reign over their business forever? And if that's the case, then the VCs will run away.
So interesting. And when I think about, before we get into, because I want to get into kind of the spectrum of funding and like how the different investors, because I think a lot of people have confusions on that, and a lot of your work puts clarity on that. But I want to go back to weighted average cost of capital, because Craig, in our training, we have a section in Principle 2 when we're talking about valuations and deal structures. Like, we say, hey, there's this thing called WACC, weighted average cost of capital, and it's actually a mathematical equation that's part of a multiple. Because how many people I know, and I was definitely guilty of this, willy-nilly multiples, right? Like, oh, you get a 10x revenue, you over here get a 5x, and they talk to their friends at, their dinner or the golf tournament, and they're just thrown out willy-nilly, but there's actual logic that goes in it. So if you could do me and the audience a huge favor, is maybe just kind of a basic explanation of what WACC is, and then how that gets into what a multiple actually is.
Sure. So WACC, like you said, is weighted average cost of capital. And, the simplest way to explain that is if we'll use very simple math here. Let's say your company is funded 50% with equity investors and 50% with bank loans. And let's say that your interest rate for the bank loan is 10% and your cost of capital for the equity investment is 20%. So basically you have half your capital at 10%, half your capital at 20%. So your weighted average cost of capital would be 15%. Now, of course, those weights aren't going to be 50-50, and those numbers aren't going to be exactly right. But that's the way to understand it. It's basically taking a weighted average of your various sources of capital and the returns, the expected returns on those. With the debt, it's very easy because the expected returns are documented,
Right.
and the is your interest rate. But with the equity, it's a little bit fuzzier. So that's the weighted average cost of capital. And so that's what you have to look at. And the reason why that's important is because so every valuation method is at least theoretically related to a discounted cash flow analysis. And so when you're doing a multiples type calculation, you're just kind of shortcutting, but underneath that is a discounted cash flow
Like
model.
there's real information, like we were saying, like it's not just made up.
So basically, that's estimating your cash flows out into the future. And then each of those cash flows out into the future, of course, $1,000 today is worth more than $1,000 a year from now. And then $1,000 2 years from now is worth even less. But how much less? And that's what you use that cost of capital for, is the discount rate, is how much you're discounting that each year in order to get back to the present value right now. And so basically, any sort of multiples like an EBITDA, again, it's like that's a profit multiple, or a revenue multiple is somehow ties into that discounted cash flow valuation that's happening underneath, but it's just kind of giving you a ballpark. Now, that's how it's supposed to work. Right now, the multiples are just kind of like crazy and seem
crazy.
and seem kind of random, and so it's 10 years ago it seemed like it worked a lot more predictably, but now.
Let's put a pin in this, because I want to go back into like when we start talking about what is actually going on right now and why, because I think you and I can have a fruitful conversation on that. But before we move on, so with the weighted average cost of capital and the how you broke it down, Craig, with the 50-50, it's very interesting, kind of tying in your earlier comment. If someone has no bank financing, which is 50% of the equation, and they don't see their company as an asset, which is the equity and the return on their equity that they should get, they truly are going to say nothing. Right? That's how they got to the nothing answer, which is I don't understand equity and what I should be getting for my own equity in my company, and I have no bank financing, so I have zero cost of capital, right?
Yeah, that's what they think. Yeah.
So there's I believe a mutual friend of ours who actually introduced me to your study to begin with, Ken Sangenario. And so he's the first person that told me what the heck WACC means. In his system, which is our whole principle for about growing value by de-risking cash flow, is founded on Ken's 8 functional areas. And he talks about company-specific risk. So I don't know if you want to speak. Yeah, I see the smile. I love it. So you want to kind of give your definition of company-specific risk and how it plays into the example you just gave?
Okay, sure. So company-specific risk is something that's used in something called the build-up method. That's a way of coming up with a cost of capital for a company, and so the build-up method, and it's very standard. So, but there's some problems with it. One is that it's based on public company data, and so it's kind of an apples and oranges thing with private companies. So what you're doing with the build-up method is you're starting with like the risk-free rate, like a 10-year Treasury bond interest rate. You take that and you add certain things to it. You add equity risk premium, because we're talking about an equity valuation, which generally is over time around 6%. So on average each year, the S&P 500 returns 6% more than the treasury bond rate.
And you're asking for, just to clarify for the listeners, you're asking for a bigger return because of the additional risk you're taking. That's all. When you're saying building up, you're just building up to a bigger return, right?
So yeah, our goal here is to build up to what the cost of capital for a company is. So we start with using the build-up method, you start with risk-free rate, which 10-year Treasury a lot of people use. Add the equity risk premium, generally around 6%. It goes up and down. You add in a industry premium or discount. So if your industry has a higher cost of capital or a lower cost of capital, you adjust for that. Size risk: the larger the company, the lower the risk. So you add in a premium or discount for the size risk. Then at the very end, you throw in something called a company-specific risk premium, and what you're trying to do is identify, is this company riskier than normal or less risky than normal? What I don't like about it is kind of a fudge factor. my apologies to valuation professionals who may disagree with me on that. But but essentially, if you have a target in your mind, what you think the cost of capital is, that's where you adjust it up or down for that company. Yeah.
Well, and I totally agree, Craig. And it was so interesting when I was going through Ken's training years ago, and I was like, what? So and then there's a whole kind of set of stipulations for valuation professionals. Like, hey, if it's above this, you might be flagged and potentially liable for the lawsuit if there's some dispute about this. So there's kind of a range that they need to get it in, right down the fairway every single time. And it's well, it's like you said, it's using this as kind of the junk drawer. But there's a lot of reality inside of that, where if you had two companies at the same revenue, same EBITDA, same industry, their operations might be wildly different. So there's truth in it, but how it's used might be either not done correctly or completely used in a different form. Is that a fair statement?
Oh yeah. I mean, there's reasons for doing that, because there's company specific risk and such. But yeah, it's the one it's the one that you would use as your lever if you somehow the rest of it is coming up with something that's not rational, so that or you don't think is rational,
right? And so if you can we can close the loop on this, of taking that weighted average cost of capital, that discount, and then saying how does that actually factor underneath the multiple, or inside the multiple, like you were describing earlier.
So basically, multiples, and again, there are other factors that I think are driving multiples more than fundamentals right now. But the idea is that it's kind of an inverse relationship. So the higher the discount rate, the higher the cost of capital, the lower the multiple. But it's so. I mean, right now, for example.
Take a 20% weighted average cost of capital or something. How would that get into the multiple?
So let's see. So 20%. I mean, the simplest way to look at it, and there are people with differing opinions on this, but just take the 20% cost of capital would just take the inverse of that, and that would be a 5x multiple. That's the simplest way of looking at it. That's not really that accurate anymore. I mean, but that's generally how it's, so.
Why do you say that?
Well, because right now we have other things going on, like a lot of dry powder in private equity and venture capital and even angel investing and such. And so there's more competition to get into deals. Mm-hmm. Which basically means that professional investors and fund managers and such are willing to overpay to get into deals, and that's messing everything up. So multiples are just a lot higher now than they really should be.
Pure inflation, right? I mean, it's inflation on the assets. I mean, it's people trying to deploy their capital, get a return somehow, and competing for it.
There's that. I mean, certainly inflation. Businesses are assets, so as assets inflate and the dollar devalues, obviously the asset's going to be worth more. But what I'm talking about is beyond that. What I'm talking about is because you have multiple investors competing for deals, they're just, and you can look at inflation that way, as too many dollars chasing too few goods. It's yes, that's a economic cycle approach to inflation. So that's one way that the assets inflate. The other way is that too much money, basically, it's not just a demand thing. It's a printing press. It's a printing press thing. Yeah. And so as the currency devalues, you also get inflation that way. And so those kind of two different, and politicians conflate the two. Mm-hmm. But those are two different approaches. So what I'm saying is VCs in particular, they're chasing these deals and competing against each other, and so the percentage of the company they're willing to take for a certain investment, gets bid down, and the amount of money they're willing to pay gets bid up, and so this is kind of messing up I mean, you never used to have, early stage, like post-revenue companies, meaning they're already selling their thing, I mean, the revenue multiples are crazy. Like,
It's insane, Greg.
like
I have no words for it.
11%, 12%, 15%, 20%. It's like, okay, this is crazy for revenue multiples. I remember when revenue multiples were like 2x, not 15x. And so so it's, so it's kind of crazy right now. And it's mostly because, there's too much money chasing too few deals. The other thing is, related to that is that so in 1980, when VC and private equity funds took off because of, they were never a very big thing. And then in 1980 and thereabouts, a couple of years more or less than that, a couple of things happened. So the capital gains tax rate changed, and so capital gains used to be taxed like regular income. Then in 1980, it went way down, and so back when they were taxed the same as income, there was no real advantage to invest in smaller companies because it was a lot higher risk, and capital gains, which is most of what you get from investment in a smaller company, was taxed the same as dividends. And so basically, equity investors tended to invest in blue chip, dividend-paying stocks, especially institutions like like pension funds and insurance funds and such. So when the tax rate changed, it became very advantageous to invest in smaller companies because you were taxed on capital gains at a lower rate. Now, the other thing that happened back then is that what was called at the time the prudent man rule, now it's called the prudent person rule, but that was a rule from the Department of Labor, an ERISA rule that basically said that you couldn't make any investment if you were managing, you had fiduciary duty, you were managing like the insurance fund or pension fund. The Department of Labor cares more about pension funds. But basically, you really couldn't invest in small private companies if you were a big fund manager, like pension fund manager, because that was considered imprudent, unwise, because of the risk profile. Well, in 1980, they changed that to be able to look at investments as a portfolio rather than on an individual basis. So as we all know from portfolio theory, is that as you increase the number of your investments in your portfolio, particularly if they're uncorrelated, you can diversify away your idiosyncratic risk of the individual investments within that portfolio and just be left with the overall systematic risk of the entire portfolio. So that allowed pension funds and such to start investing in private equity funds and venture capital funds because those were portfolios instead of individual investments. So the upshot of all this, why I'm getting this little history lesson.
And this is where, because just to interject there, enter the scene, KKR, Blackstone, all in the 80s. I mean, King of Capital, that book, like it was like, oh my God. I mean, Steve Schwartzman and Pete, I can't remember Pete's last name, Pete Peterson. I don't know if it's, but anyways, both of those two, I mean, they started and they're like, I mean, they're like systemic risk to the whole world now because of how big Blackstone is. I mean, it's ridiculous, but they started in the 80s, didn't they? Somewhere around there?
Yeah. So this all started, so basically both private equity and venture capital just exploded after that. And generally, so lots of capital started flowing into venture capital and private equity for that reason. And over time, though, so venture capital started out actually investing in new ventures. That's where the name came from. But then since then, they've moved away from startup investing into growth company investing. So people that are more on the later stage of a new venture where they actually have profit, or even if they don't have profit, they have very, very high growth. So the reason why I bring that up is the situation right now is it's gotten so competitive for these VC firms to actually deploy their capital, to actually make investments, and limited partners are investing in their funds, but the money's just sitting there because they can't find anything to invest. So now VCs are actually kind of moving back earlier stage companies. For the main reason is because if you get in early on a company in an early round, then you generally have rights of first refusal on the later rounds. So now VCs are shotgunning money out to these earlier startups. They know only one out of 10 is going to make it into a growth company, but it's worth it to them just to have a foot in the door, so that they can, they still are interested in growth stage mostly, but they invest in the early stage more and more these days in order to get their foot in the door and be able to have access to the growth stage investments, which
and probably to be able to also close the door on other people and protect the cap table for themselves would be my guess.
Yeah. So it's basically it's a defensive move, and because they're having a hard time getting their dollars invested because they can't find the good deals to do that, and the best way to do that is to kind of seed these earlier stage companies so they have access to them later on.
Well, and I think about as we continue this conversation,
and by the way, that's another thing that's driving up these multiples is basically it's this. All this dry powder or money sitting in these venture funds that isn't invested. That's what dry powder is.
Let's take just the math, Craig, and if it's $2 trillion that everybody's saying, or give or take $1 trillion, I've heard varying degrees, but let's say it's $2 trillion, and VCs and private equity firms who traditionally do the 2 and 20, 2% management fee and the 20% on the upside of the carried interest.
Yeah.
And they're getting charged 2% on non-deployed money that's just sitting there. So what's 2% of 2 trillion? Is that 200? Is that 200 million or is that 2 billion? I don't even know. Is that 2 billion? Probably.
I don't do math during interviews.
Yeah, well, I shouldn't do that. I should say that for my team, no matter what. But that's what I'm doing is trying to reinforce your point, which is, they're charging their investors 2% of the money they haven't spent yet. So at some point, if you and I had the $100 million fund and we haven't spent it, it's been 2 years and we haven't bought anything, our investors are going to be going, why, Craig and Ryan, have you not bought something yet? Go find a deal, and then we're going to end up overpaying just to continue the cycle.
Well, one way that's handled in a lot of funds is, if it's a 10-year fund, and most of these funds are 10-year funds, they will at the first few years, or maybe even the first 5 years of the fund, the management fee will be based on committed capital, and so they're going to get paid 2% based on that. But at somewhere along the point, like at year 5, it'll transition to invested capital, because the first year of the fund, of course, all the capital isn't going to be invested. They're still looking for investments and such. So you're, as an investor, you're giving them a chance. They have to be able to run their venture firm and keep the lights on. So it'll be based on committed capital, but then at some point it will transition to invested capital. So they'll only get the management fee based on what's actually been invested. So a lot of funds work that way.
Which again, if you're in year 4, spend the money so you can, because otherwise your cash flow runs out as a firm.
So they're desperate to spend the money, and so you just wonder, they have a little bit of a moral
FOMO
hazard there. Exactly. Basically to take bad deals, or maybe just suboptimal deals, in order to get their money out, because they have to do that, and generally overpay. Which overpaying for an asset works out fine as long as the people buying it from you are also overpaying on the back end. But if they're not, if it's a fair valuation, then you've just cut your investors' returns by overpaying on the front end.
And that's that musical chairs, and you just want to make sure that when the music stops, that you're not the one holding the bag, right? So without the chair. And
exactly.
So I think what's so refreshing and fascinating about this conversation, Craig, is I didn't know any of this stuff years ago, at all. Running a business with all these high impact decisions we have to make every day, which is why I've gravitated towards the study that you bring, because we can go look up CNBC, we can go to Wall Street Journal and get public market information. This is what Ken Sanjanara just beat into my head, is that is not the same as privately held companies. Because I know, after interviewing 17 banks trying to get new financing in 2012, it's not the same as saying, hey, we have another percentage of the company we're willing to sell, and just boom, a bunch of money comes into our account. So How did, after you start teaching, kind of maybe give us the birth story of the study and what was your intent with the study and kind of what's in the guts of the study?
Okay, so I did not start it. I joined Pepperdine in 2011, and this had already been going on for a few years at
Oh,
that
when
point.
was the first study? When did that go out?
First one was 2009.
Okay.
And so I had been at Pepperdine about a year, so it was about 2012 that I took over, because my predecessor John Paglia, who came up with this whole project, got promoted, and he needed somebody to take over for him. So I did, because it was right up my alley as far as my research interest and teaching interest. And so I've been doing it since 2012.
Got it. So, and for the listeners, what is so for Pepperdine and for your predecessor, like what was the purpose of it, and kind of walk us through the methodology of the study and what's in it? Because I think the whole goal, and we're going to be adding links to in the show notes for people, because I think it provides a completely different lens of information that people don't get elsewhere, and hopefully through this podcast and the exposure that we'll be getting, we can continue to increase the reach that you guys have.
Okay, so and I hinted at this earlier, but so the report has a lot of data on industry trends and financing trends and all that. But when it comes down to it, the main purpose of it is determining cost of capital and making it easy. Like Table 1 in the report every year summarizes cost of capital from various deal sizes and various sources, and so that's the money table, what most people look at, Table 1. And the reason for that is because of John Paglia and the person he was working with at the time, Rob Slee, just felt that the build-up method, which we talked about earlier, was flawed. And that's not the best way. That the problem is because you're using public market data and you have that whole company specific risk premium thing going on. It's like, okay, this is you're kind of backing into your result using the build-up method. So the idea here, so they want to come up with a different approach to determining cost of capital. And so since cost of capital is an opportunity cost, it means investors and private businesses, they have a broad range of possibilities that they can invest in. So they have to be convinced to invest in your company rather than all the other possibilities they have, whether it's public company stocks or bonds or other private businesses or whatever. So you have to attract their company, their capital to your business. And so in theory and in principle, cost of capital is an opportunity cost, and so the expected returns of the investors has to equal, on average and over time, the cost of capital to the business. Because if you don't return what the investors are expecting, they'll take their money elsewhere and such.
Well, and let's I want to interject right there, because if business owners are not thinking like an investor, they're never going to even think about the question you just proposed.
Yeah, it's true. And the majority don't think of it on their own. They have to be, somebody has to tell them, it's like, hey, this is how it works. And then they go, oh, yeah, that makes sense. So the idea here is that, so we need to get at what the expected returns from the investors are, whether it's the investor is a bank issuing a loan or an angel investor or a venture capital fund or whatever. We have to get at what the expected returns are. How do we do that? So John and Rob originally came up with the idea. Well, why don't we ask them?
Novel idea, right?
So that's where the survey came from. Is just asking all these various capital providers, hey, what are your expected returns? And then that is by this idea that cost capital is an opportunity cost, that's how we're getting at what the cost of capital is for these various types, by asking the investors themselves.
I love it. It's just like the customer feedback. It's like, hey, why don't you just ask your customers what they want? You're going to get a lot of good information.
So the idea here isn't to replace the build-up method. It's basically to do a real-world checkpoint against it. And
I love it.
so that's how a lot of people, how a lot of valuation professionals use our report, but it's generally as a check against what they're doing, because the build-up method is well established in the courts and such. And so they're not going to go away from that, but they do want to do a reality check.
I love it. And I think what you just described from your survey and the build-up method is, okay, I want to hear your response to this concept that we've been playing with in our training, Craig. And it's because I think it has to do with, in principle 3, we talk about exit options. So we kind of build up in our training of like, hey, what do you want from the business? Here are your financial targets, how valuations and WACC and all this stuff work. And then here are the exit options. Then what do you do with it? You grow value to create the choices that you want, so you can pretty much pre-engineer exactly what you want. But then there's this whole, like, depending on your exit, let's take 2 examples, like an ESOP versus like a strategic sale. So like with an ESOP, it's going to be based on the value method, primarily the build-up method. Discounted cash flow is going to be based on the risk of the cash flow and how that cash flow can service the seller and the senior lender. Like to your point, what are the returns that they need for that risk of the cash? But it's going to be mainly based on, like, the company has got to pay for the debt. I mean, pretty much to pay for the buyout, so that there's like a direct correlation between the cash flow and that value. Strategic buyers can overpay for all the reasons we talked about. And then you throw on the fact that that strategic buyer might be backed by a private equity firm with all of the assumptions that you mentioned, and the strategic nature of deploying someone's product or service through 3,000 customers that they wouldn't have had to be able to cross-sell to. So there's a premium difference between like this, what we call, and here's what I was looking for feedback on, is we call it intrinsic financial value, pulling from a lot of Ken Sangenario's work. Like, here's the risk of the cash flow and the value associated with it. And then over here, we call it strategic transaction value, where it's that one point in time where the company switched hands for a variety of reasons that are above and beyond the risk of the cash flow. And so and the reason I'm bringing this up is because when we talk to people, and I do this in the presentations that we do, is we say you can control the cash flow risk of your operations, and you can pretty much pre-engineer based on, if you're going to go to a bank or an ESOP, you can pretty much pre-engineer your valuation that you want. Over here, there's all these unknowns that you don't know from the industry, what's hot, what's not, all the stuff that's going on, that I have suggested to people. They go to your survey to say, hey, this is what's happening on the strategic transaction value, so they can directionally go, hey, I might have a 30% premium by selling to a third party, but I'm gonna have to gut it. I have no control over it. And is it worth it or not for them? That's like what we're trying to give them, is the data point, but we've never been able to get any information that's super legit outside, for comps. So it's like, hey, go to the Pepperdine study, because just to give you an idea, industries, multiples, ranges, sizes, that is different than just looking at the build-up method. So that's how we've been using it. And I just appreciate what you guys have been putting together, because of, it's how many pages? Like I said, it's
120 usually. Yeah.
it's not small. What are your thoughts about how we're using it in our discussions?
Yeah, I mean, that's exactly right. Like, yeah, there's a huge difference between a valuation done for an ESOP. ESOPs they legally are required to do a valuation every year and such, and they use the fair market value method. And that's generally, and they're using a build-up method and very according to a certain formula and such, which is well supported in the courts and such. That's not the same valuation that you're going to get if you're actually selling the company. And so on the market, and generally, well, just to give you
I was going to say, on the market is a really important distinction there, because, and just for some clarification, when we say, you can monetize your business through an ESOP and still be the CEO, which is your wage in your job. So we have to differentiate those two, because this is why I hate the words exit planning, because people don't even know what they mean. And it's like, well, technically an ESOP, you're monetizing your business, but you could still be the CEO. So like when you say, I want out of what? I'm not sure. And so it gets all conflated, versus saying like, hey, I want a third party sale, and these are kind of the attributes with a third party sale.
Yeah, I mean, another popular solution, if you just wanted to monetize and is do an equity recapitalization, equity recaps. That's a private equity deal where you generally you sell like 55% or 60% of your company to a private equity fund, and then you keep the 40%. You stay on as CEO, and then get a second bite at the apple later on, a few years down the road. The idea is the private equity firm is going to help you increase the value of your company during that time, and then when you sell your remaining 40%, you'll actually make more off of that second sale than you did off the first one. So that's an equity recapitalization. So that's a way to do it, to monetize it without actually leaving. And like you said, the ESOP is another way people do that. But exit strategies as a whole. Now it's interesting. Traditionally your best bet was to sell your business to a public company. That was in a strategic sale. That was what would get you the highest price. Then after that, sell to another private company. That would get you a little bit less. And then like third was a financial sale, like to a private equity firm or something. That was number three, way down the list, because you get your best prices, public company, private company, then private equity. Well, now that's flipped.
Well, I was just going to say that's not what I see.
Yeah. So now, because private equity firms are just grotesquely overpaying for companies because of the competition, your best bet right now is selling to a private equity fund, and then probably a public company, then to a private company. But it used to be that the private equity deals were the ones, they were the people with the sharpest pencils, who were trying to wring every possible dollar out of you and pay the least. And now they're being super generous because, they have a lot of dry powder again, and have to get these dollars invested. So right now, private equity is the best. Other thing that's interesting, just along those lines, is we always ask this every year in the survey is, if you could qualify for doing an IPO or selling to a private equity fund, which would you do? And it's and let's see, it's always been the case that people have chosen, since we started the survey, private equity over IPO. And so So let me go up to the.
Go for it. I'm on the edge of my seat waiting for your answer too.
Okay, so this year I'm going to tell you the numbers for that. So, 56% of owners picked private equity over IPO. 17%. So basically, 56% said they'd go private equity. 17% said they'd go IPO. Now that's a real change from from historically, where IPO was always the brass ring that everyone was reaching for, and such. And now they just look at private equity as, okay, you can get really rich off a private equity deal without all the hassle of being a public company.
Yeah. Isn't that, it's so crazy watching these shifts happen. And that's right. And I think so much the complete paradigm has shifted since 2020, when all the money got pumped in and there's just so much stuff happening, and the volatility. It's things change from day to day. But I think what can we take out of all this? I think some of your descriptions of hey, if your cost of capital, if your business is growing higher than your cost of capital, you're winning. If it's not, you're not. And it's about, I think, Craig, for myself, thinking about myself a decade ago, the people listening is what can I control? And then what do I do about it? That's what we're trying to get to. And so I don't know if there's even a question in there. It's more of just there's so much that we've talked about, but there's so many actionable things to do about it, but it's even just keeping people pointed in the right direction. So when you guys walk through the survey methodology, because not only should everybody participate next year, but then also you're just launching the 2021 one that you're launching? Or is it 2022?
So we finished the survey for 2022 now, and we're just compiling the report, and that'll be out within a couple of weeks, hopefully a little bit earlier than that. So that's the 2022. We've done the 2022 survey. We're doing the 2022 report. Yeah, the way it works is, and essentially what we've done over the years, we've built up these survey panels and always looking for new people to join in. So that's so very important for people to do that. And then, we put them out there right now, essentially from 2021 all the way back through history. Those reports are free, and there's a link to them. If you go to privatecap.org, all one word, privatecap.org, then you have access to all the reports. So the 2021 and before. So it's always the current year we charge for, and we started doing that a couple of years ago, just because we
keep
lost
the funding going.
Yeah, we lost our internal funding, so the current one you have to pay for current year, but all the previous ones are free for download. So yeah, just go to privatecap.org.
It's a nominal fee too. It's like a little bit over $100 or something like that.
Yeah, this year it's $125 for the 2022.
And we'll put the links in the show notes for everybody, because I think the goal is to use this directionally to say, hey, like, what does it mean? What does it mean to the listeners, right? And I think it's just a great source of data that you can't just pull up the TV and see a bunch of information about private markets. It just doesn't exist.
Yeah, it's really opaque, that whole area. I mean, that's why every finance textbook you read in an MBA program or what have you, it's all going to be talking about public company valuation. And why is that? Even though the number of private companies dwarfs the number of public companies, yet it's because of data. You just don't. The public companies have data, so that therefore all academic stuff really defaults to public companies because availability of data. And so private companies is a lot harder. So hopefully we are making that easier by providing data about private companies.
Craig, this has been an absolute blast, and I appreciate how simple you've brought all this information to everybody. Two questions I like to ask as we wrap up. The first one is what the word intentional means to you, because it's the name of the show, and I think there's a lot of meat behind everybody's different ways that they define it. But what does the word intentional mean for you?
It means, instead of just going for it and hoping for the best, actually having a plan.
Again, you just drop the simple bomb again. I love it. That's seriously amazing. And then you've already the second question is, where do people get in touch with you? The reports you said it again, but any main areas you'd like people to go?
Sure. I mean, my email address is craig.everett@pepperdine.edu. On LinkedIn, my handle is Craig Everett, all one word. Let's see. And on Twitter, it's Craig_Everett.
I thought you were going to bust out TikTok or Snapchat. No, no.
Yeah, I was doing some TikTok last year, just doing like snippets, talking points from the report and things that I could do in under a minute.
Oh, cool.
And and probably once this report comes out, I'll do a little bit TikTok.
That's awesome.
Probably not.
You're above me, man.
No dancing.
No cooking.
No cooking. I may involve my dog in it somehow, because that seems to be popular. But
I have this vision of Craig cooking and talking about WACC. Craig, thank you so much for coming on this show. This has been a blast.
Well, thank you, Ryan.